battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 43 years, it's been the Stenger family's mission to deliver both clarity and confidence to help secure your financial future. How do we do that? We do it through these shows, through our Investor Day conference that is coming up very quickly, completely sold out. We can't wait to see you coming up very, very soon, November 7th and 8th, downtown Naperville. And I will just tell you, if you're planning ahead for 2025 for next year's Investor Day, which will be called 2026 Investor Day, you should start thinking about it. And if you couldn't get on this year's lineup, we are going to have much more room next year, and it will be in October. We're going to bump it up a little bit. So weather-wise, if you're coming to us from a different place, it will be a little bit warmer here in the Chicago area. But you don't want to miss that conference. You don't want to miss these shows every week. We're trying to give you the good news, the reasons, math, statistics, why you should stay on your plan. And nothing tells you that better than episode 165 that we're on today, the title of it being Goldman's Bearish Outlook. Goldman Sachs came out with an extremely bearish outlook, very glum outlook for the stock market the next 10 years, saying the S&P is only going to go up 3% a year. I'm here to tell you today in a second why I believe that's completely wrong. And if you listen to that, you're going to really, in my opinion, cost yourself a lot of money. But also, I had a couple clients this week say, Nick, everything out there feels like monopoly money. How can I trust the stock market? How can I believe what I'm seeing? Yeah, things have been good for the past couple years, but are they going to be good in the future? Why is the stock market so high? Aren't we due for a correction? These are all the questions that are circling around in all of our minds. And so I want to tell you today why I believe the doom and gloomers in the short run could be right, but in the long run will be wrong. And then we'll get into the Goldman Sachs. We're going to do a little bit of a shorter show today and get right into it. So, number one, everything feels like monopoly money. There is some monopoly money going on, and there's no question. When you pump $5 trillion, that's about what we pumped into the economy, $5.4 trillion of new money, new M2 money supply. That's how we track it. Yes, some of it feels like Fugazi, woozy, wazzy money. Why? Because when you give, if everybody's got $100,000 and you print their money up by 40%, now everybody's got $140,000. Nobody actually has 140,000 of real dollars. Everybody's just equally the same as they were before. And that's why Milton Friedman said that money printing, that inflation always and everywhere is a monetary phenomenon. If you print a bunch of dollars in the economy, those dollars are worth less. It's not rocket science. There's really nothing to debate here. But I was at a First Trust Financial Forum conference, one of the best ones that I go to all year as part of our due diligence event or due diligence meetings. I was just there this week. I've gone to this one 3 or 4 years in a row now. And Brian Westbury has pointed this out consistently, that Milton Friedman's points about monetary supply are very important to understand. And Jerome Powell has not done a whole lot of talking about M2 money supply at his Fed conference monthly meetings. And so this is a big problem. Nobody at the Federal Reserve is really bringing up the point that when you print $5.4 trillion of new money in the economy, you blow out the spending, it creates some issues. Now, the question is, are those issues now or are they in the future? And I think what's very important to understand is the money printing causes problems for the banking system. Absolutely in the short term. And you saw that. And by the way, a lot of people say we haven't ever had a recession yet. Milton Friedman said, if you print all this money and then you stop printing the money, then you have a recession. You go back the other way. And everyone says, well, the recession hasn't happened, so it must be coming. This is my big point of differentiation, especially where I disagree with the Bears, is that I do think we had a recession. I think we had one in 2023, and the NBER, the National Bureau of Economic Research, just never reported on it. They never said it because we were in a midterm year. And you're like, Nick, oh, you can't say that. That's like a conspiracy theory. And, you can't say that people were hiding the numbers. The government was fudging the numbers. Yes, I can, because there's economies all over the world that do that. And if you've ever heard of China, a place that does this all the time, they make up the GDP data. They don't really tell you what's going on. I do think the numbers weren't made up. The numbers were published. The numbers said that we had 2 declining quarters of real GDP in a row. That's a recession. If you've taken economics or any sort of university level classes, that's what you learn. And so the reality is, I do think we had a recession in 2022, but because it was a midterm year, we just didn't report on it. So you look at the rest of the economy, and things are actually going pretty well for the most part. And so I know this is going to not appeal to certain people on the political aisle. I just said something that angers one side. Well, I'm going to say something that angers the other side, because we like to call balls and strikes as we see them. And that's that the economy is actually doing quite well right now. And so whether you like the current person in the Oval Office or not, and whoever you want to come in 2 weeks in November here, it doesn't really matter. The data points to things going pretty well. Not for every person in the economy, not for every company, every sector, every industry. I'm not saying that, but broadly speaking, people are still doing pretty well. Consumers still have money. Spending is still going on. People still have their jobs, and profits are growing. And so, yes, there has been some fugazi, woozy, wazi money printing. However, technology has bailed us out. Technology has really rescued corporate profits. So while in a normal economy, when you print the 40% of new dollars, a stagnant vacuum economy, yes, everybody's the same as they were before. However, when you have a dynamic, tech-enabled economy like we have today, this is my opinion, I believe that is what helps us outgrow inflation. That's what helps us beat inflation over time. And I was doing a presentation for a group of CPAs last week, and I had somebody asked a really, really good question. We were talking about autonomous, we were talking about AI, talking about NVIDIA, and somebody in the audience asked a really good question. They said, Nick, isn't all this autonomy isn't going to put people out of work? Isn't it going to be a really tough change? And I said, yes, absolutely. It's going to be a big change. There's no way you're not going to have some painful parts in the economy as we go to a new industrial revolution here and to new technology, of course. But at the same time, new technology has always created more jobs. It's always created more wealth. It's always created better standards of living. You cannot point to a single time in history where that's not true. And you could have said, Nick, aren't cars going to put horse and buggy people out of business? And isn't that going to be bad for the economy? Well, yeah, in the short term, if you're making buggies and all of a sudden we go to cars, yeah, your buggy business ain't going to do so well. But what did all those people do? Now they're building cars. Now the cars have computers. So there's people that program those computers. There's people that make the tires. There's people that make the steering wheel. There's somebody who does the marketing for online. There's somebody who does the payments. The economy is just so incredibly complex. And so the idea that you're going to centrally plan it or that you're going to be able to predict what's going to happen is foolishness. And so anybody who tells you they know exactly how things are going to work out long term is wrong. They don't know. They have no idea what the future holds. But what we do know to be true is that human nature doesn't change. And if you allow human nature and you allow people to embrace creativity, if you allow the government to shrink in size and you allow the individual to increase in size and you allow people to be creative entrepreneurs with innovative ideas, what do you get every single time? Well, you get growth, you get innovation, you get entrepreneurship. And the result of all that is better things for all of us. Our 401k balances go up, the stock market does better, our standard of living goes up, and even people at the very bottom get pulled up to higher standards of living than you'd never have with central planning. And so I would just argue that capitalism, that entrepreneurships, that our country, yeah, we've got our problems, yeah, we've got our issues. While all of that may be true and is true, the reality is our country, our entrepreneurships, our freedom of speech in a lot of cases has lifted people out of poverty in a way that communism, that socialism never, ever could do. So it's not perfect, but it's the best thing we got. And so if you're not looking at what's going on behind the scenes with whether it's SpaceX with Elon Musk or Starlink and all the cool inventions that are happening, you're going to miss the broader point. Because just as an example, whether you like Elon Musk or not, the guy is just a genius. I mean, he's a modern day Edison. He's just phenomenal to watch. And if you watch him, what he's doing now is he's sending up thousands and thousands of these Starlink satellites into space and getting internet to places you would never have it. He's getting it to places in Montana where if you're just hunting or fishing and you're in the wilderness, you can literally pull up your phone on your Starlink plan and have a very quick speed internet in the middle of nowhere. But what's even more important is look at North Carolina and everything going on there with the weather and the flooding. And within 4 days, Elon Musk came in with Starlink, and all these people were back on the internet who wanted to be. That is just so cool. And then even further than that is the fact that now you can go to any communist regime that has turned off the lights, any place on earth where they've had this authoritarian crackdown on the internet, authoritarian crackdown on free speech, and he can get the internet into those places, which is so incredibly important that people can hear debate. They can hear people debate ideas and freedom of speech. And if you want more democracy, if you want more worldwide freedom, less suffering, and more abundance, you should want entrepreneurs to lead that. And so why is the economy, why are things going pretty well right now? I'm not going to say perfect, but going pretty well. And why is the stock market so stinking high? Why is the S&P at 5,800 points? If you're watching this today on Friday, what is it, October 25th? Well, I think the answer is because of company profits. It's that simple. And so I have said this to you on the show so many times, but I've got to remind you, because if you don't listen to it here, you're going to get thrown off your plan when you hear these doom and gloom stories from Goldman Sachs. And that's the basic equation of how the stock market's valued, which is earnings times price, the valuation we put on those future profits. Why are future profits worth something in the future? Because it goes back to accounting 101. If you've taken an accounting class, one of the first chapters in the book, the textbook, is the going concern. How viable is the company in the future? Well, if you've got a company that's viable in the future, they're innovating, they're making stuff that everybody wants, they're producing great value for clients and for their shareholders, well, they've got a good going concern. They're going to be okay, most likely, as time goes on. And so those profits aren't really valuable right this second, in the sense that we already made profits from last quarter. We made profits from last year. What Wall Street and all of us want to know as investors is, what are those profits worth going forward? And so that's why we take next year's profits and multiply it by a forward-looking price to earnings multiple, the PE ratio. And so right now, we expect, top Wall Street analysts expect $310 to $315 in earnings for 2026. I think that's might be a little different. We always have some revisions here and there, but usually we're okay on earnings. And I think companies will do whatever it takes to protect margins. And so we're going to be fine on earnings. That's my opinion. The biggest question that comes up is, Nick, what do you value those earnings at? And so this is really what Goldman Sachs is saying. Goldman Sachs isn't saying the bottom's going to fall out. They're not saying that the world's coming to an end because profits are going to go down, although they do think we're going to have a earnings recession temporarily. Okay, fine. Maybe not. I don't know. But the bigger thing they're saying, which I kind of disagree with, actually largely disagree with, is the fact that they say those profits are going to be worth less in the future. And what they do is they take the current multiple on the S&P of about 21 times earnings. That's our forward-looking number now. And they say that's higher than it's ever been. It really should be 18 or 17. But see, what they're doing is they're going back over hundreds of years of price to earnings multiples. And I could be wrong about this, but I believe that companies are fundamentally different today than they've ever been. And the reason I think that is because when you change your entire economy or change your entire business model from transactional to reoccurring subscription-based revenue, your subscription-based revenue is always more valuable than your one-time sales. Obviously, we all understand that intuitively. Our business has turned that way. The business of a software has turned that way. You used to buy a disk and put it in your computer. Well, that was one time, and then they'd have to do a bunch of updates and sell you a new disk if you wanted to upgrade your software. Well, now there's a whole thing called SaaS, SaaS, software as a service, and that's subscription-based software. Well, when software companies changed to a subscription-based model, their companies became so much more valuable because instead of selling you a one-time disk that you put in your computer, they're now selling you a subscription that goes into perpetuity as long as you decide you want to be a client. So that's much more valuable. And so most of Wall Street has figured this out. Number one, Wall Street's figured out, or I should say companies on Wall Street have figured out that reoccurring revenue is critical if you want to get higher multiples. So naturally, we should trade the S&P higher as a multiple than before. If earnings used to be 10 times on transactional business, you can easily say earnings multiple should be 20 times on reoccurring revenue. So right there, you get multiple expansion. Another way you get multiple expansion is just by the company boosting EPS, growing earnings per share. So there's a number of ways to grow your earnings per share. One is you grow top line revenue. That's the best way. That's what we want to see. We want to see companies growing revenues. We screen for that in client portfolios. But number two, then you can also increase EPS by reducing your costs. And then there's also back end ways to do it through corporate buybacks. And so corporate buybacks are simply a company buying back its own stock, reducing the number of shares. And that's a very, very good thing for investors. Corporate buybacks are phenomenal, especially if you look at Apple. Apple has boosted its earnings per share in a large way from corporate buybacks. And that has just been huge for Apple shareholders. If you've owned Apple stock, you've seen your stock go up, not just because they're selling a lot of iPhones, and they are, but because services revenue has gone up and they're paying dividends and they are doing corporate buybacks. So I believe today, and this is where I disagree with the Bears, I disagree with Goldman Sachs, that simply put, Wall Street analysts and the pundits, the as Brian Westbury has called them, the pouting pundits of pessimism, have what they've done is they've just not done good analysis on what profits are worth going forward. So we all pretty much agree profits are going to be pretty good. I think those profits are going to be worth 20 to 21 times in the future. And that's where we take the 310 to 315 times earnings or earnings estimate, multiply by 20 or 21. And we end up with an S&P north of 6,000 points, whether it's 6,000, 6,100, 6,200, 6,300. You can put your different multiple on that and figure it out for yourself. But I believe the S&P is at least fairly valued, and I actually think it's a touch undervalued as we go into next year. So is it the best buying opportunity on record if you're looking to deploy cash? No. But it's certainly a buying opportunity. If you've got a long time horizon, meaning 5 years or more, you got to be in the market. And so that's the reality of being an investor. The first best time to invest was 10 years ago. The next best time, the second best time to invest in stocks is today. And as we go out the next 5 or 10 years, I believe earnings are going to be up, companies are going to be more valuable. And I believe because of that, your portfolio will be higher. Don't try to time it out. Don't try and get in and get out and say, oh, I'm waiting for the election to see what happens. That's a common thing we hear. I'm waiting to see what happens in 2 weeks. Well, guess what? I think we're going to get a pretty favorable outcome in 2 weeks of at least divided government. And if we get divided government in 2 weeks, man, the stock market, I believe, is going to go higher. It may not go higher in a day or two. It may be lower temporarily, but in the long run, divided government sends the stock market higher. So, if you think you're smart enough to time this out, if you think you're smart enough to know when to get in and get out, know when to hold them and when to fold them, when to walk away and when to run. All right. Well, there's a lot of really smart people, hedge fund managers out there who literally have 400 CFAs on staff with 55 screens on their wall of Bloomberg terminal research, and they can't beat the S&P 500. They can't beat the market. They can't figure out when to time it. and somehow you think you're going to on your Schwab app or your Fidelity app, good luck. We wish you well on that. I don't think it's possible. I think you just buy and you hold for the long run and you get on a good goals-based plan. Of course you have risk management. Of course you have a goals-based plan. But as far as you trying to figure out the ins and outs of the market, that's a losing strategy long term. So stay on your plan. If you have trouble doing that, give our firm a call, Stenger Family Office, and subscribe to our YouTube channel if you don't mind. You'll get all the updates on the new stuff we've got coming out. You'll get all of the updates if you subscribe on Apple or Spotify. So please do that. Thank you if you've already done so. And that really helps us get the show to more and more people. Thank you so much for being with us for episode 165. We'll see you next time for episode 166.